Hello and welcome to this latest edition of Courses on Demand brought to you by Forex.Academy. In this particular course, we will be discussing trading equity indices. And just before we begin, there is, of course, inherent risk in trading the financial markets. So please do become familiar with the following disclaimer. In this particular webinar, of course, we will focus our attention to discussing trading equity indices. First of all, defining what they are, and having a bit of a debate in terms of how they relate to economic performance or a view on the health of the overall economy. Obviously, equity markets have a real concern or influence in the trading of our financial markets, so we'll discuss that in a lot of detail, whilst moving on to discussing some of the main global equity indices across the world. We'll look at equity market correlation in terms of how they trade in tandem together and the relationship with risk. And then obviously finishing off with actually looking to trade the equity indices themselves. So let us first define exactly what equity markets are. Equity markets, they provide companies a way to raise needed capital and give investors an opportunity to profit by participating in the trading of that company's stock. One of the main benefits of trading stock is that investors can become partial owners of a company, and this of course will be dependent on the percentage of company equity owned. So that's what they do. Companies obviously need to finance their obligations. They'll go to the market and actually sell or issue equity. Investors will then, in search of return, choose to purchase that equity, hoping that there will be capital appreciation on the share price. And obviously there are many different ways in which investors can actually benefit in terms of value, dividends being one of them, and actually looking to make profit over the term of the investment. Shares are offered by companies in return for money, and they're called equities. In the United States, the main equity indices or markets are the NASDAQ 100, that's the tech-heavy index, the Dow Jones Industrial Average, and the S&P 500. Equity consists of funds that shareholders invest in a company, plus a certain amount of profit earned by them that is retained by the company for further growth and expansion. Equity is a primary asset class when it comes to investing and diversifying one's portfolio. Trading equity needs in-depth analysis and research of the share market environment. And that certainly lends itself to fundamental analysis, that we know there is a lot of legwork in terms of the actual study and research that goes into fundamental trading. So let's look at exactly how equity markets are indeed priced. Most indices across the world will use a market capitalization approach to pricing. So a market capitalization weighted index uses the market cap of the component, and that's price times the free float shares, or the amount of floating shares out there in the world, as the weighting factor. Consequently, in this construction, the sum of all market caps are divided of all the stocks in the index at any given time by a quantity that is the sum of the market caps at some initial time divided by an initial index value. So quite a complicated description there, and we have quite a complicated mathematical function to actually derive the price of an equity. More similarly, or in a more simple approach, we can look at the table there to the right-hand side where we see the securities. So let us imagine ABC is an equity index. We have a price. In a more simple approach, we have the table there to the right-hand side. What we can see really is some securities there. ABC is perhaps one company, DEF another company, XYZ another company, and DOGG another company. So we have 4 companies within this potential hypothetical equity index. You can see they all have prices for their own stock and the amount of shares that they have perhaps in the market. That will have a value simply by multiplying the price times shares, or the free float shares in the market, and then obviously adding them all together will give us a derivative price of a floating equity index price. And this will move in terms of market sentiment on the overall shares or securities within the index itself. Just on a separate note then, we have the S&P 500 there just put in there, just to give you an example of one equity index that obviously has 500 companies. Each one of those companies has a share price that is all added together through this mathematical equation here, and we get the price at the moment at 2,638. So that is in general how most of these equity indices are actually calculated, and this free floating price trades in the market. We have the total number of components within the equity index itself multiplied by the amount of shares that are out in the market, and obviously that is all plus together to give us an overall equity index price. So let's delve into defining equity markets in a little more detail by looking and describing the relationship of the investor and the company itself within the markets. The investor has a specific role to play. Obviously, it's interested in equity ownership. Now, what specifically does that mean? Well, it means that when an investor decides to purchase perhaps 1% of Amazon, it actually becomes part owner of the company itself by buying the equity or shares. And obviously, denominated in the amount of shares or value of that share expressed as a percentage, it will be a 1% owner of the company. The company is listed then on the stock exchange, and it does so because perhaps it wants to raise some capital for expansion. Perhaps it wants to expand. Amazon, for example, would like to expand in many countries it's not yet common or popular in. So they actually look to sell shares or sell some equity in the financial markets to be snapped up by eager investors. The aim of the investor then is to search for a return on investment, which is ROI, basically to make profit on this investment. And that's particularly important or different in equity markets as opposed to other markets like simple price speculation or trading would pose. Because you become a part owner of the company, you actually are entitled to some of the profits of that company. So you're entitled to dividends. You're also entitled to many other advantages of actually being part owner of the company that could delve into more profit in the future. So there are serious advantages to actually investing as opposed to just trading the price of the share. With the company, it issues shares to raise capital, which we have discussed. In terms of the investor, portfolio diversification is very much an important factor for those who want to diversify their portfolio. And that means just spreading risk across different asset classes. You could choose something a little less risky, like a selection of government bonds in a portfolio, whilst combining with a little more risk associated assets, potentially like some company shares or equity shares across the market. The company competes within the industry for growth. So obviously it is difficult to compete in a large monopolistic environment that we live in now, particularly in some of these large tech companies like Amazon, Google, Facebook. They are very, very competitive indeed. They're looking to compete within this industry and growth, and the more access to liquidity from capital from investors they can get will obviously serve to benefit many of their obligations and objectives. The investor itself can be either an individual investor, or institutional. So many of the large firms, pension funds, for one example, are a very large institutional investor that invests in stocks, shares, and bonds, and all of these sort of different financial securities. And the company aims to provide its shareholders with a return. So they do have a fiduciary duty to actually provide some return to shareholders given that they invested in the company stock. So let's look at some of the largest equity indices across the equity markets here. We have Obespa there in Brazil, the JSE in South Africa, ASX in Australia. Obviously, the US equity indexes, we have there the NASDAQ 100, the tech-heavy index, the S&P 500, the largest by market capitalization, and the Dow Jones Industrial Average. More centralized in Europe, we have the FTSE in Dublin, we have the ISEC, the CAC 40 in France there, IBEX 35 in Spain, the DAX in Germany, the SMI in Switzerland, and then more across Eurasia there with the ME in Russia, and obviously SSE in China, NSE in India. So there are plenty of these equity markets across the world, and there are plenty more that aren't actually on the chart here that add liquidity to the equity markets and that obviously provide individual trading opportunity in their own right. But all of these collectively are known as the equity markets, and they have a certain level of correlation when trading. There is an overall level of business activity that we look at towards the equity markets to provide us with economic performance or signals of economic performance and growth. The performance of the equity markets is particularly important in reflecting the overall business sentiment within a region. The largest equity index within a country will consist of its largest companies, usually determined by market capitalization. Their growth and level of production all contribute to the many underlying variables that buoy the underlying health of the domestic economy, such as labour costs, wages, unemployment, and consumer confidence. It is crucial then that these companies are able to gain exposure to the financial markets so that they may acquire the capital they need for expansion and for their own investment opportunities at a business and commercial level. So the equity market influence is absolutely huge. It's absolutely massive when actually understanding how the economy itself operates. Here, what we have here is the FTSE 100 sector weighting, and we have a pie chart where we can see as a percentage at different levels of degrees of the sector of influence across the UK. Particularly with the 100, the FTSE 100, we can see that we have some very important sectors driving this economy. Oil and gas is one sector there, so it's 14% of the actual weighting of the FTSE 100. And as we note there, we have BP, which is one of the world's largest petroleum oil companies, and BHP Billiton, which again is heavily in, of course, mining and oil and gas as well. 21% attributed to the consumer goods sector of the FTSE 100. So that's absolutely massive. If you consider how the consumer goods service actually hires a lot of people, how does that contribute to labour costs and wages across the UK? We have such companies like GlaxoSmithKline, which is a pharmaceutical company, and Diageo there, I do believe they are the leading drinks maker in Europe. Absolutely huge components of that equity index. And obviously the transactional cost and value that they bring to the UK economy is absolutely unquestionable. And then we have financials, which attributes to 18%. So that's a huge figure alone, 18%. If we think of these large companies such as HSBC or Standard Chartered, really world leaders in terms of global banking, and they obviously bring a lot of business back to the UK, global business. If you think even, the amount of employment they bring to the UK, and of course the amount of tax that they generate for UK customs and revenue, absolutely huge, which would be supportive of the overall economy. Now, what does this equity market influence mean for us as financial traders? Obviously, the topic of our discussion here is trading equity indices. So we need to know how these sectors can affect the equity indice price and how we can look to profit from these moves, and obviously how moves in the stocks alone can look to influence the equity index. So let's look at BP within our oil and gas sector, which is a large sector of the economy, or the FTSE 100 more specifically. BP is the third largest equity in the FTSE 100 with a weighting of 7.9%. So 7.9% as a weighting within our 100 companies is quite large. HSBC is the largest equity in the FTSE 100 with a weighting of 9.2%. So you could see, of course, how a drastic news event affecting either one of these shares could have a larger effect on pricing the FTSE 100 itself as an equity index. So I have chosen the case study of the Deepwater Horizon oil spill there in the summer, June 2010, just to show you such a huge effect some news or negative news can have on the overall equity index. Obviously, it was an oil rig from the petroleum company BP in the United Kingdom there, and the spillage was a huge spillage in the Gulf of Mexico, which obviously attributed to drastic change in the share price of BP, and therefore the overall weighting on the FTSE 100 given its constituent weighting. We can see the huge decrease in the share price there from around $62 to a low of $26 in a very short space of time. So this was an absolutely huge event that caused a massive shock in the oil and gas industry, and of course really affecting BP itself at an overall share price level. This of course has a huge effect on the index. So let's have a look at how this influence can cross over to the equity index itself. So if we were to analyze or ask ourselves the question, how much influence can one particular equity have on the overall effect or price of the equity index? Well, of course, the answer is quite a lot. And when we see these sharp declines, particularly because of one equity within the index, it's very significant indeed. So obviously with this particular event, we know first and foremost that BP is the third largest equity within the FTSE 100 with a weighting of 7.9% of the index. a huge decrease in its own share price was felt. And with those other equities, particularly that are in the FTSE 100 within the same sector, oil and gas, such as Royal Dutch Shell, those would be gravely affected in terms of their own share price. And this is going to have an overall weighing on the sector and the FTSE itself. So we see the FTSE actually trading down quite sharply as a result of this massive news shock event, leading to long-term price decline. So what I would like to do is to better describe the makeup of global equity markets themselves so that you can grasp a better understanding to what you're actually trading when deciding to trade the price of these equity indices. So over the next 3 slides, we'll look at some global equity markets, and we'll start with the NASDAQ 100 here. The NASDAQ 100 itself is a stock market made up of 104 equity securities issued by the 100 of the largest non-financial companies listed on the NASDAQ exchange there in the US. It is largely dominated by companies from the technology sector and is often viewed as the benchmark for tech sector traders. So starting off with the weighting here, you can see the top weighted companies on the left-hand side: Apple Inc., Microsoft Core, Amazon, Facebook Inc. Very familiar companies, and we can see the extent to how large their weighting is in terms of a component within the NASDAQ 100, with Apple there, the top competitor, or the top constituent of 11.6% of the weighting. You can see why it does have such a significance in terms of being described as technologically heavy. All of these companies, Apple, Microsoft, Amazon, Facebook, Alphabet, which is Google, Intel, Cisco Systems, Comcast, all the top performers and weighted companies within the NASDAQ 100. And obviously, their share price will move in accordance with new tech sector news and price swings within the sector itself. So very important to know that you're actually trading the NASDAQ based on the prices of all of these shares as they move within the trading investment community. Having a look at the FTSE 100 here, it is an equity index consisting of the top 100 companies listed on the London Stock Exchange. Components are assessed by market capitalization, and the index is maintained, of course, by the FTSE Group. So a little more of a mix-up in terms of sectors itself. Obviously, it is not provided to give support or more strength to one particular sector. Being the top performing equity index within the United Kingdom, it obviously has a good makeup or a good selection of diversified stocks. First and foremost, if we look at the weight, we can see 9.2 is HSBC, a financial institution, of course, a massive bank across the globe there. It is by far a leading component in terms of making up almost 10% of the actual total weighted price of the FTSE 100. And then we look at companies such as Royal Dutch Shell, BP, two massive companies within the oil sector and heavy players within that industry itself. And then we have a selection of many other companies such as Vodafone, GlaxoSmithKline, AstraZeneca, which is a pharmaceutical company, British American Tobacco, Rio Tinto, again, heavily within the mining industry. Again, a good selection of equity shares within the top 10 here of the FTSE 100. But you can see how the sector is dominated, I suppose, by certain sectors of economic activity, particularly with oil and gas industry, as we've seen across the sector weighting, and financials there. And obviously, if there's a big swing or if there's something like a financial crisis, some of these equity markets are going to be more affected than others, considering they are heavily weighted by one particular sector. The final global equity market I chose just to analyze in some detail here is the DAX 30. The German DAX is a blue chip stock market index consisting of 30 major German companies trading on the Frankfurt Stock Exchange. It's operated by Dutch Börse and measures the 30 largest companies by order book volume and market capitalization. So it is a little difference there as opposed to just a weighted capitalization. As we look across the company weightings, we can see that Bayer is the leader within the German DAX, a 9.9% weighting within that index. We see companies like BASF, Siemens, SAP, Allianz Insurance, Daimler, Deutsche Bank, Deutsche Telekom, Lind, E.ON. So a good selection of telecommunications, technology, insurance. E.ON, I believe, is in energy. So quite a diversified collection there of securities within the DAX 30, and that could provide a totally different trading or investment opportunity as opposed to perhaps the tech heavy NASDAQ 100 or the FTSE 100, which is dominated by financials and the oil and gas sector. So that leads us nicely into actually discussing equity market correlation. Why would that be? Well, we've just looked at sectors and how there's different correlations between firms like BP within the oil and gas sector and how those sectors can move the equity index themselves. But there are more specific equity market correlations across the globe. Investing in equity markets is inherently a riskier investment than other safer asset classes. This is because equity markets offer growth and ownership, and as a result, for the potential for higher reward. Each equity is subject not only to its own performance, but to the larger economic performance of the market. As a result, all equity markets are correlated to the extent that they share the same risk premia. So why might that be? Well, because they share the same risk association within the investment community. And to choose but another example, if we discuss government bonds, each and every government bond issued by its government is inevitably backed by its government. So the government will, of course, pay the debt back within a certain period of time. So collectively, they all share the same risk premia as opposed to riskier investments such as trading in equities. Those that trade in the same currency and same region will be closer correlated. Other indices which share an overweighting of a particular sector will also be more correlated in relation to others. A lot of this correlation has to do with the sentiment and how the investment community perceive any risk or threats to either value or growth. So let us paint a picture or an image in our minds of how these equity markets are correlated. More specifically, they're more correlated over longer periods of time. So what I've chosen as a case study is the financial crisis of 2008, and you can see how the crisis affected the S&P 500 and then the ensuing or aftermath recovery period moving on towards 2012. What I'd like to do is just go over this chart with many different equity indices. We have the NASDAQ 100, the FTSE 100, the DAX 30, and the CAC 40, just to show you that these are equity indices across the world, but that they share a serious level of correlation in terms of the recovery. And it's all conclusive of how equities and sentiment traders perceive risk. So first and foremost, we'll look at the NASDAQ. Again, obviously, because of the different component and constituents within index, it will, of course, deviate from price, but you can see the overall trend structure is very similar. Then we have the FTSE 100 again, selling off very sharply with the financial crisis and then recovery in a similar fashion. And then we have the DAX German. Again, we have much more of a structured recovery a bit earlier, since obviously the financial crisis would have affected those US assets more sharply at start. And then the CAC 40 or the CAC 40, we see a little more volatility, but then the recovery is very well structured as well. So what we can see across these equity indices is there is, of course, equity market correlation from a period of 2007 to 2012, so 5 years of very, very close price action, given how the market fundamentals really affect these equity indices. When we discuss trading equity indices, more generally, what is good for the domestic economy is good for the equity markets. So supportive economic data will create bullish sentiment for the equity markets, whilst weak economic data will increase bearish sentiment for investors and traders looking to trade the markets to the downside. There are many variables to consider when trading equity indices, and this is helpful for anyone out there who is considering taking long-term positions in the equity markets, or perhaps even scalping the equity markets as a result of consequential news that comes out each and every day. Currency. So we've seen obviously the Brexit situation caused a huge shock in the currency, and that revalued the price of the FTSE 100. Politics is, of course, a contributing factor in many ways in terms of influencing central bank monetary policy and how that can affect interest rates and many other variables that affect the economy. Whether there's discussion with conflict, political discussion to go in and out of conflict, that, of course, has very heavy effects on pricing equity indices. Company news, of course, we use the BP example there to express how volatile price action could be as a result of company news. Economic data is, of course, a very obvious factor in terms of pricing these equity indices as traders position themselves and react to global data to provide more knowledge and understanding to how the overall economies are performing. And then corporate earnings is, of course, a huge factor in pricing equity indices and, of course, in pricing the actual underlying shares for each of those very large company constituents within the indices themselves. Again, for us trading equity indices, it's very important to understand and to assess how significant some of these single stock equities can have in determining the overall equity index price. We have seen intense competition in equity markets, particularly over the last 20 years. This has sometimes led to monopolies in tech, media, and natural resourcing. As the power of these firms grow, so does their contribution to the global economies. This means their own activity and share price is having a greater effect on equity index trading. So let's have a look at one example here. We can take the Spanish lender Santander. Santander is the largest equity in the IBEX 35 with a weighting of 17.87%. What would happen if Santander got involved in, say, a corporate scandal, for example? How significant of an effect could this have on the equity index itself? So I'd just like to leave you with that, some food for thought in understanding really that some of these companies, some of these firms are so huge that they have such a significant weighting on the particular equity index. And when there are huge shocks or changes in their price, that will obviously feed into changing the price of the equity index. So equity markets provide us with fantastic trading opportunity. We know how they are priced and how they reflect overall business performance of the domestic economy. We can take advantage of equity markets to identify good trading opportunities and spread risk across markets. Collectively, equities are the one asset class that is driven more by investor sentiment and confidence than by trading or financial planning community. So the fact that investors are more involved in these decision makings than just mere price speculation, for example, with trading, or the financial planner who's looking to diversify in bonds and ETFs and different things like that. The investor is much more focused in on fundamental analysis and is driving the market from a sentimental position. So that brings us to the end of our discussion on trading equity indices. What did we learn? Well, we discussed through and through equity markets with the relation to economic performance and how equity market influence can be very significant in pricing equities and their indices. We then looked in much more detail of the makeup of these equity indices and looked at describing them in terms of risk premia and correlation. Then we looked at some of the key factors in trading equity indices and hopefully now understand the dominance or the sheer impact that some key players out there, huge firms, can have on indice pricing themselves. So that brings us to the end of this course on demand brought to you by Forex.Academy. Thank you very much for joining us and we'll see you next time. Bye for now.